Jamie Dimon, of course, making headlines that this boom can go on to 2023. But the real question is, can the equity market boom follow that, given that I think we're price to sales of 3 times and a price to earnings of 23 times on a forward basis? What do you think?
Well, I think I've always felt that the risk was that this could turn out better than we could have ever hoped, risk to the upside. And so if you take a look at the data and the numbers, I think we just want to remind investors that the economic data, which actually looks pretty good, is already past tense, and things have gotten actually better since then. And so forward looking, if you're looking at the market itself trading at 21, 23 times earnings, if you actually take out the top 10 stocks out of the S&P, we actually get a PE ratio more towards 19, which frankly, sitting now in this low interest rate environment doesn't look that expensive. And so from an investor standpoint, I think there's plenty of opportunity to reset portfolios here, particularly at the sector level and at the thematic level, as we see these digital economy themes now actually start to take hold.
And so therefore, at the sector level, at the company level, are you still looking at digital themes, or are you looking more at what has been the cyclical trade that's won thus far, the financials, the energy stocks?
That's right. Yeah. So I think there's more room to run in this sort of COVID reflation theme as we move towards actual traditional inflation. The market, again, is a present forward indicator. And so if this post-pandemic rescue works, we should see inflation. It's actually something that we want. And so what we want to advise investors to do is what to do from here going forward. And that would be to continue to own financials, industrials, materials, stepping delicately into small and mid caps. We've had a good run in those, taking a look at emerging markets as well. But I want to caution, more importantly, the one thing I think people need to pay a lot of attention to is that negative real rates in cash money market accounts is sort of the silent money killer in terms of purchasing power. And so my real call to action for investors right now is that cash is not a safe place. It actually is the one place you can guarantee a loss right now. Yeah. Very different than stepping into portfolio volatility, which you can easily manage through good investment discipline.